Hey guys, welcome to yet another video. And my name is Dave, founder of PXC. And today we're going to be talking about when you should leave the markets alone. When you should leave the markets alone. You don't have to trade every time. You don't have to um, show up every time. I mean, most of the time you need to back test, at least back test, study your mistakes and failures. You don't have to trade every time, and that is why very few percentage of people actually last long enough in the markets. So yeah, and today I'm going to talk about why and when you should leave the markets alone. So yeah, let's get to it. So yeah, the first on our list is when the price hunts your stop loss, then moves strongly in your direction. I know a lot of everyone hates this. This is like a nightmare for every trader, and is also a very big indicator that you should leave the market alone. You don't have to when you see when you see the market moving like that, you don't have to trade all the time. You just need to leave it, leave the market, ignore the market, focus on back testing, wait it out. Now I'm going to show you an example of when it hits your stop loss and goes in your direction. This is a perfect example. Let's say right here. This is perfect. Now, if you see the price, this is an obvious trend line right here. This is an obvious trend line right here, not properly drawn. Let me see if I could add to it. Okay. Basically, there's a trend line in this area, and it is obviously showing lower lows right there. If you can see my screen properly, and if you notice, it's bouncing properly, readily on this trend line. But when it got to this point, it actually showed the rejection right here. It showed the rejection right here. Let me just zoom in a little bit. Right here, indicating, and I'm very sure there was good volume. I don't want to go into that now, but I'm pretty sure there was good volume right here for like a perfect sniper entry. But this happened later. It hit, cleared you out, and fell so deep right after. Can you see this? So when the market starts acting this way, maybe once or twice, 3 times, you know, okay, this is when you have to run away, leave the markets, keep it aside, touch some grass, do some back testing, reduce your lot size. You don't have to trade every time. That is one of the secrets in trading. You need to trade when it's much more favorable. Things like this, movements like this will make you question your strategy, make you think, okay, yeah, what exactly am I doing? Okay, I think I need to go and buy or find a new strategy. I mean, that's why people are never consistent. They don't stick to that good strategy that works for them. So yeah, this is very important. When you see stop hunts like this, avoid the markets. So let's get to the next one, which is hardly hits your TP even when you're trading with the trend. I mean, this is self-explanatory. Like, let's say you're trading the market, like you're following the trend, and you notice, okay, yeah, I'm buying here or selling right here, and you notice that, okay, yeah, the price isn't, yeah, probably went your way, but it didn't hit your TP before reversing hard. Do you understand? It probably just went halfway, maybe like a 1 to 1 movement, then it's reversed hard. So movements like that, have it in mind that the market isn't good to trade. I mean, for that day or that week, or sometimes that pair is not actually good to trade at the moment. So I recommend you ignore the markets at that point. So yeah, moving on to the next reason why you should leave the market, when you should actually leave the markets, um, is when the price ranges in smaller time frames. This is basically okay. Now, every strategy, every good strategy, um, for every good strategy, you have to all your entries have to be in smaller time frames. These are entry time frames. So when you notice in these smaller time frames, the charts do not move. I mean, the price isn't moving smoothly, but in a range bound environment, you know, okay, yeah, this is when you should leave the market. This you shouldn't actually trade. The market isn't really good enough for trading. Now I'm going to show you an example using the EMA 200 with the 50 smoothing. Now look at this. Okay, this is kind of like this is a good example. You can see the EMA is moving straight bound, piercing through the price levels right here. If you can see on my screen. Now, when you see the market looking like this, you know, okay, the market is not good enough. Entries is going to be much more difficult. It's not smooth. It's not good enough to trade in this kind of levels. So this is when you know, okay, yeah, you need to ignore the markets at this point. I mean, I can show you an example of very good smooth entry point. I mean, when your price, if you can see my screen, when the price looks like this, pierce through the EMA is trendy. I like to say it's trendy and moving smoothly. It's not this. I think this is a very good example of another range bound movement. When it's moving smoothly like this, then you know, okay, yeah, the markets. I mean, there's volatility. There's good money flow. This is another good example right here. Basically, if you're using the EMA indicator to um, find a ranging or trendy markets, especially in the smaller time frames where you take your entries, then EMA is very good at filtering. Now this is a very good entry right here too in these levels. When you see it's far away from the EMA and moving smoothly downwards. So yeah, basically avoid range bound movements in the smaller filtered charts like entry charts rather. These are good movements right here. If you can see this is perfect. This is not this you know okay yeah there's volatility and the price is good. But when the price movement is good, but when you see movements like this, you know there's some sort of manipulation coming up and you should avoid it. This mostly happens, yeah, this is worse actually. This mostly happens in Asian sessions and also yeah to get better at trading, avoid movements like this, avoid range bound movements in entry charts, smaller time zones. Yeah, moving on. The next on our list is price formations and patterns taking forever to form. Now, this happens mostly in the filter chart. Filter chart basically where you find your entries, where you find your your trend. Now, basically, let's use this as an example. Let's say the price, you're trying to find the trend, you're trying to know where the market is going before you find your entries in smaller time frame. And let's say it's the price. Let's use this as an example. The trend line right here breaks, and yeah, like it breaks right here, reversed, went back to retest. Let me get rid of this so it won't confuse us. It went back for a retest right here. So when you know the market isn't favorable to trading right now is when the reversal pattern right here, I think this is a bearish engulfing right here. If it's taking forever to form, you know, okay, yeah, the market is in a bad state right now. You shouldn't trade. Ignore. Do not trade or probably go in with lower lot sizes, low risk if you want if you actually must. But with in my experience, it doesn't really take too long to show up. It's price patterns actually form really fast in a good market condition where there's volatility. So when you notice, okay, yeah, this isn't forming anytime soon, avoid the market, ignore the pattern, or just wait it out, watch to see how it goes. So yeah, avoid when price patterns, when candlestick patterns rather, takes too long to show. So moving to the next, and the last on our list, when the lower time frames entry take forever to form. So now when we go back to the lower time frame, I said something about entries and all. For instance, let me use this. Let's say you're using EME breakouts as our entry point. Now, imagine it breaks out right here. Like I said, imagine this breaks out right here and it's taking forever, or let's say it's taking forever to actually break out at this point, at these levels. I mean, if you see this, this is an example, like I said, this is an example of a really good market with good volatility. Now, it actually broke these levels easily and it went up. Now, this is an example of a bad market struggling to break through these levels. For instance, it broke here, went back down, broke again, went back down. This is really struggling, and this can be related to um sorry, this can be related to number 3 on our list. It ranges, there's no volatility. This can be related to zero volatility in the market. And once you see things, price movements like that, I recommend you do not trade. Ignore the market, wait it out, find a different pair to trade on. You mustn't trade JPJVY every time, or BTC USD or gold. You can find other charts that are actually favorable and there's volatility, because volatility is what moves the market. So yeah, that is basically it. In conclusion, I'm just gonna go over it one more time. When you should actually leave the markets alone. When the price wants to stop loss and move strongly in your direction, hardly hits your TP, even when you're trading with the trend. Ranges in smaller time frames. You shouldn't try to play smart in the market when you're trying to make entries, especially in smaller time frames. There's too much noise for you to be trying to trade breakouts and all of that in smaller time frames. So avoid it. Price formations and patterns are taking forever to form, especially in the future charts where you find your trend. When it is taking too long, in fact, when you see like a breakout happening and it's taking forever to happen, or you see fake outs, which I'm going to talk about in another video, avoid it. Do not try to be smart. Do not force any trade. So yeah, price formations and patterns have to happen fast. When it's happening fast, it shows there is volatility. Um, and the last is when the lower time frames entries take forever to form, which is relatable to number 3, ranges in smaller time frames. In a good market, everything happens fast. And when everything happens fast, it shows there is volatility and less manipulation. So yeah, that would be it for today. If you have any questions, you can join our Telegram or send me a message directly to answer your questions. In our next video, we'll be talking even more about when you should trade the markets. I've probably said this a lot, and I'll say it again. Never, you don't have to trade every day. Some traders actually leave the markets for months, for a full month without doing anything. So you don't have to force any trades. You don't have to gamble on the market. That's basically the quickest way to giving up and losing all your funds is trading on like in a bad market condition. So avoid trading in bad market condition if you want to last long as a trader, if you want to become a pro trader. So I hope you learned something new today. See you in the next video. Peace out.